If you want to make $100,000, $1 million, $100 million, anybody can do it. Welcome to Real Estate Market Moves. I am starting out in San Francisco today. That's why I have this San Francisco background. We're going to talk about the commercial real estate bloodbath going on. Let's jump on over to San Francisco and what's going on. A local buyer are setting a new floor for the market at prices 75% off previous values. We've had several office towers and office buildings trade in New York, in San Francisco at about 75% off of their previous purchase price. This one right here is Peninsula Land and Capital bought the first San Francisco office building this fall. The Palo Alto-based private equity company, commercial real estate investment fund, paid $40 million, just over $40 million for 550 California Street in San Francisco, a 13-story tower in the North Financial District. It previously was purchased at around $120 million. That's a 60 to 75% discount and probably in the $100 a square foot range. You cannot build anything anywhere near close to that. Buildings like this will cost you $300 to $500 a square foot to build in the current market environment. So it's really interesting what's going on. What are they going to do with it? We don't know. It's still currently, I think, 25% occupied. They'll most likely, those tenants, I think, are on their way out. They might try to repurpose these as housing. They might repurpose them into mixed use. They could tear them down and redevelop the site, turn them into a hotel. It just really depends. A lot of different things you can do with these with an adaptive reuse type of play, those types of things. But several of these buildings have traded in San Francisco. So now the floor is being set around 75% discount. So that's wiping out all the equity investors and wiping out the debt on the properties. But San Francisco is not alone. Chicago, the same thing's happening in Chicago, same thing happening in Detroit, Portland, Seattle, all of the major cities that are in, that have had negative migration, that have had, the remote work affect them greatly. We're seeing the same thing happen where buildings are trading at 40 to 60% off, wiping out the equity investors, wiping out debt holders. Then the next question is going to be, is this something that is going to potentially tank, the economy or the real estate market at large? Again, there's about 1.5 trillion in commercial real estate debt that is due. A lot of these buildings that are vacant in the cities, this is just what's going to happen. And you're going to see these things wiped off the map. There's probably, 500 billion or so of these types of assets that are potentially at risk, and a $30 billion asset valuation, or a $30 trillion asset valuation. So commercial real estate in the United States is valued around 30 trillion, 35 trillion plus or minus. That's the value. As these assets go down, the values change. So where we've had these conversations where net worth can be meaningless. At one point, that building was worth 120 million. Now it just sold for 75% off at 40 million. That net worth gets wiped out if you own that building. Also, it costs several $1 million to carry these buildings. You have taxes, insurance, maintenance. You got to keep some sort of security going, things like that. I mean, these buildings can cost several $1 million a year to carry. But the big thing is the net worth gets wiped out. So net worth is meaningless in a declining market. But again, it's not enough to really tank the economy. It's a very small portion of the overall commercial real estate market. At scale, it's just a few buildings and a few cities here and there. At this point, anything can happen, but at this point, it's not a systemic thing that's going to potentially take down the economy like housing did in 2009. Is the housing market going to crash? What are the experts saying? So there's a lot of talk about the housing market crashing. There's been a lot of talk about the housing market crashing ever since the recovery of 2008 and 9. And the interesting thing this time, again, is the inventory situation. So, one of the biggest issues of the housing market, potential housing market crash, is the, inventory situation. There just is no inventory out there in most markets. Now we're seeing inventory rise in a couple of markets, Austin, Texas, Boise, Idaho, Phoenix, Arizona. I mean, there's a few markets across the country where you're seeing inventory levels start to rise a little bit, but in general, in most markets, there's still a lack of inventory, especially with rates hitting the highs that they've hit recently. So does that mean that that the housing recession is over, that the housing recession is bottom? So what is a housing recession? Two things. One, obviously it's prices. We haven't seen prices drop. We've seen prices go up. We've been covering the weekly housing market update here every week. Prices continue to go up, even with record high rates. The median house price. So every market's different. Real estate's hyper local, just like in commercial real estate. The different assets are going to trade differently in the different cities. Housing is the same way. Different types of houses are going to sell for different pricing in different areas. Some areas are still getting multiple offers on certain price houses. Other areas, inventory is starting to stack up, and you're starting to see potential defaults and foreclosures in some areas. Investment properties are under pressure because of taxes, insurance, maintenance, all those costs going up, doubling, tripling, and even quadrupling in some areas, insurance in coastal markets. So a housing recession is two things. Most of the time you think of a housing recession as prices. Prices have not come down. Where we saw a recession in housing is in transactions. So we've seen transactions crash in housing. We've seen transactions crash in commercial markets, down as much as 60 to 80% in some markets. Housing transactions are down 50 to 60% in a lot of markets, but there's still a lot of cash buyers out there. 30 to 40% of the transactions are being done all cash, and even more in some markets. So right now we'll just have to wait and see. Like I said, the median house price is continuing to rise and hold steady. And that's one of the things that could potentially happen as we go along, is that what I'm thinking in terms of where we are from an inventory standpoint is that the housing prices are going to kind of hold steady. And while, incomes potentially start catching up with that, because it's all an affordability thing. People are buying payments in general. Some people are paying cash. There's a lot of people with a lot of cash out there that can still pay cash. But in general, most people are paying for a payment. And as interest rates go up, you can afford less. As interest rates went down during the pandemic, people could afford a lot more. And that ultimately is what ended up really messing the housing market up. Neil Kashkari from the Fed came out last week and was being interviewed. And he was asked, did the Fed destroy the housing market? And he said, no, we did not destroy the housing market. The inventory, the supply destroyed the housing market because of the pandemic. We haven't been able to get enough houses built. There's a lack of supply out there. Home builders can't build fast enough because there's no labor. We couldn't get materials. Prices went up, all of those things. But at the end of the day, what drove that record demand was record low interest rates, because it became cheaper to buy than to rent when interest rates were at 2.5%, 3%. And that also drove prices up, because people, normally they could only afford a $500,000-$600,000 house, could now afford an $800,000 to $1 million house, because it was all about the payments. The problem is taxes, insurance, maintenance on those bigger, more expensive houses are the things that are going to catch up with people ultimately, that thought that just because the mortgage payment was low, that they were going to be able to afford that bigger house. So that could potentially shake some things up, bring some more inventory to the market. So really, really interesting times in the housing market right now in commercial real estate. And it's all based on rates. And we'll take a look at now, with these rates. Rates have had a huge drop lately in the last week and a half, coming off that 5% range. Now I'm talking about treasuries, the 10-year treasury, because residential rates and some commercial mortgage rates are loosely based on the 10-year treasury, because it's a risk-free yield for investors that would otherwise buy mortgage-backed securities. That's the other thing that the Fed did. Not only did they drop the Fed funds rate to record low levels, which can affect some commercial rates, but treasuries were dropping as well. And they were buying treasuries, and they were buying mortgage-backed securities, keeping everything, keeping that demand out there and keeping rates low. So those are the things that affected other investors' appetite for these instruments. So as rates go up, investors, instead of buying, commercial real estate for a 5 cap, they can get a 5% return risk-free in a 10-year treasury, because that's what, investor capital looks for, that's buying mortgage-backed securities. They're looking at that delta and that risk in real estate versus a risk-free return in yields. And what we've seen lately here in the last couple of weeks, we've seen, since that 5% hit on the 10-year, we've seen it back up all the way down to 4.469 yesterday. And what that's done is mortgage rates hit 8%, 30-year mortgage hit 8% back the 23rd of October, the week of October 23rd. Now they're down to about 7.5 to maybe 7.8. 7 to 7.8 in that range, somewhere around there for the 30-year mortgage rate. That's still going to keep a lot of pressure on a lot of people. it did spur some demand because you can get buy downs. Now you can get rates if you get a 3-2-1 buy down starting at 4.5%. So it goes 4.5% the first year, 5.5% the second year, 6.5% the third year, and then it resets to 7.5%. So builders are offering those buy downs. You can get interest only loans. With commercial, you can get floating rate debt. You can get a lot of these short-term interest-only loans. The danger is that rates will continue to stay up or go up, which is what's putting a lot of pressure on people in the commercial real estate market as well. So rates are very important. They're very critical. The other thing that's going on is rents. So rents are up and rents are down. It depends on where you're looking. So in some areas, we're seeing rents fall, in cities because new construction, Austin, Phoenix, Atlanta, Phoenix, Arizona, Atlanta, Georgia, rents are dropping because we've got a lot of supply coming on. But in some other areas, we don't have a lot of supply coming on of new multifamily units being built, and rents are increasing. Also in, single family for rent homes, built for rent homes, America's largest single family landlord keeps raising rents. So this is Invitation Homes. Invitation Homes is an institutional investor. They have 84,697 single family homes. And, the rents are continuing to go up. So the year-over-year shift in average rents charged by Invitation Homes, the largest owner of single family homes, you can kind of see over the years where they've gone up. South Florida, Tampa, Phoenix, Atlanta, Orlando, Houston, Dallas, the Carolinas, you're seeing pretty much across the board. Denver, Colorado rents were down, but it's really interesting, again, how hyperlocal real estate can be, no matter whether it's values of properties or rental rates, other than commercial. Commercial is really taking a beating. Those office towers were renting for $80 to $100 a square foot at one point in downtown San Francisco. Now you can't give space away for free. People just don't even want any part of it because people don't want to go back to work in the office. So what does this mean for you? How can you play this? If you're looking to get into real estate, or if you're looking for a house, you want to buy some investment properties, things like that. It's all about the liquidity. It's all about the financing. You got to be able to get the debt. The debt's got to make sense so that the property will cash flow. There's very limited inventory, so you have to be ready to strike when something comes on the market that's going to suit your needs and fit your criteria. And just kind of keep an eye on that. So we're coming into the time of year, seasonality in the housing market, where typically you see inventory reduced. We've already got low levels of inventory. It could potentially reduce it even more, but we are seeing some inventory come on the market in some areas just because rates are so high. It's sidelined a lot of buyers. So some areas we're seeing inventories pick up. Other areas, again, inventory continues to decline. So when it comes to housing, we're still in that waiting game, waiting for higher rates to play out, waiting for some more distress in the housing market so that people eventually are going to have to move, going to have to sell. A lot of reasons: job change, moving for family reasons, divorce, death, a lot of different reasons people become sellers. So eventually, and then building more units, building more inventory, builders offering incentives, bringing inventory online. In the commercial real estate market, keep an eye on multifamily, keep an eye on these office buildings. Again, there's going to be very high holding costs for office buildings if you are raising funds to go out and take advantage of these discounts in the office to reposition those assets or do something like that. Not every asset can be repositioned into something else because of the footprint, the floor plate, the cost, things like that. The carrying costs are very expensive. Multifamily, there's a lot of multifamily deals coming through the pipeline in the next year because their debt that they bought on floating rate or interest-only debt is coming due in the next year to 18 months. So there's going to be a lot of multifamily properties coming online at deeply discounted rates. So you want to keep an eye on that. Industrial is under pressure in some markets. Industrial was largely overbuilt during the pandemic because of the stay-at-home trade, people buying online, shopping online. As the world opened back up and retail has made somewhat of a rebound, that's put a lot of pressure on industrial. A lot of markets, especially the DFW area, there was a lot of expansion in industrial in that area, in the Californias, those types of areas. So keep an eye on that. Keep an eye on rents, vacancies, occupancies, things like that. No matter what type of investment property that you're looking to buy, it's all about the occupancy levels. It's all about the rates. You want to make sure that the rates of rentals are holding steady. And when it comes to housing, it's all about inventories, right? How many properties are on the market? How many are under contract? how many are selling, and what do the days on market look like. So we're seeing, that again, different markets, they're all hyper local. So you got to be really in tune with those things as you're out there looking around. So that is your real estate market update. I'll see you on the next video.